The return of President Donald Trump has brought not only political expectations, but also a spiritual boost to the crypto market. While many countries, including China, are aggressively testing CBSE central bank digital currencies, digital legal tender controlled by central banks, Trump has chosen a different path. He declared he would never allow CBSEs in the United States, citing concerns about privacy and excessive state intervention. But what's more noteworthy is this: he doesn't oppose the entire process of currency digitization. On the contrary, Trump shows an open attitude towards stablecoins, a special type of cryptocurrency, not as noisy as Bitcoin, not as rigid as CBSEs, but steadily making its way into global financial life. Stablecoins are a peculiar kind of money. They don't have the potential to make you fabulously wealthy overnight, nor do they threaten the existing financial system with anti-establishment declarations. They simply replace slow, expensive, and limited methods of money transfer with something faster, cheaper, and more accessible. If you've ever transferred money from the US to Asia, you've likely seen this clearly. An international transaction through the SWIFT system, established in 1973, still takes 1 to 5 business days, with service fees ranging from $25 to $50, not to mention hard-to-control intermediaries and non-transparent exchange rates. In 2023 alone, the world lost tens of billions of dollars just sending money. Meanwhile, stablecoins like USDC, USD, or DAI can perform the same transaction within seconds, regardless of time zones or nationality, and almost for free. No banks, no business hours, no approvals needed. Just an internet-connected device. In a world reeling from the speed of technological development, governments have been forced to change. They may no longer see Bitcoin as the #1 enemy, but they clearly maintain a cautious attitude towards an asset class that is too difficult to control, borderless, has no single entity behind it, and cannot be turned off by a simple decree. In this context, stablecoins emerge as a point of balance, not as wild as pure crypto, but also not as constrained as CBSEs. They lie at the intersection of the old and the new, between stability and innovation. From a convenient solution for transactions, stablecoins are now becoming the foundational layer for a new global financial system, where the US dollar exists not only as paper money or bank accounts, but also as tokens operating 24/7, decentralized, and permissionless. Perhaps Trump saw that stablecoins are not just a haven from volatility. They could be the bridge for a comprehensive financial reform to begin. A leap forward without having to tear everything down. So how are stablecoins being used? What types of stablecoins are there, and which models have failed spectacularly? The story of transaction volume surpassing Visa, the Terra collapse, new generation blockchains no longer charging fees. All are opening up a very different future for what we call money. Let's begin. This video aims to help people understand more about the crypto market in general, as well as the basis for clearly recognizing the strength of Pi Network in particular. Knowledge will help you rise above the rest of the world. Please like, share, and follow the Pi From Us channel today. We will continue to explore cryptocurrency together. Part 1. From tokenized dollars to a new financial foundation. Typically, stablecoins are known as USD on the blockchain. Although the majority of current stablecoins are pegged to the US dollar, reflecting its central role in global trade, the market is expanding to include other units of account such as the euro, British pound, Japanese yen, gold packs, ZA, and even real-world assets like carbon credits. Each type reflects a specific need: local payments, currency risk hedging, or creating a new store of value. However, the US dollar remains central. The first stablecoin Tether USD was created in 2014 by the Bitfinex team, with a simple model: deposit $1 in the real world to receive 1 USD on the blockchain. Despite years of suspicion due to a lack of transparency, Tether has thrived and, by April 2025, reached over $142 billion in supply, becoming the world's largest stablecoin. From there, stablecoins began to differentiate, not only in terms of technology, but also philosophy. They can be divided into 3 main types. 1. Fiat-backed stablecoins. Stablecoins pegged to traditional assets. This is the most common form of stablecoin, and also the most readily accepted by the traditional financial world. The structure is very simple. Each stablecoin token issued to the market is backed by exactly 1 unit of USD or an equivalent asset, usually T-bills, short-term bonds, held in custody at a bank. This is why organizations like Tether with USD, Circle with USDC, or previously Binance with BUSD chose this model to build trust. The biggest advantage of fiat-backed stablecoins is that they are easy to understand and integrate. They function almost equivalently to cash and banking apps, stable, less volatile, and compatible with current accounting and banking systems. For businesses, this is a safe bridge solution between crypto and traditional finance. However, the price to pay is centralization. Because they depend on custodial banks, assets can be frozen, accounts can be controlled, and issuance rights belong entirely to a specific organization. For those who believe in decentralization, this is a significant limitation. 2. Crypto-backed stablecoins. Stablecoins collateralized by crypto assets. Unlike stablecoins backed by fiat currency, crypto-backed stablecoins are fully collateralized by crypto assets like ETH and operate directly on the blockchain, without needing banks or custodial institutions. This is the preferred choice for those who believe in an autonomous financial system where everything is coordinated by smart contracts and users control their own assets. A typical example is the DAI coin from the MakerDAO project. Users collateralize ETH in a vault, and the system issues DAI at a collateralization ratio higher than the issued value, usually 150%, to create a safety margin. When users want to withdraw their ETH, they simply repay the DAI along with a small fee. But if the price of ETH drops sharply, the system will automatically liquidate the collateral to maintain the safety ratio. Crypto-backed stablecoins offer decentralization, but their stability is only as strong as the market's ability to maintain equilibrium. When the collateralized assets begin to plummet, a DOS delegated proof-of-stake system, trust in the stablecoin also faces its most severe test. 3. Algorithmic stablecoins. If fiat-backed stablecoins place trust in banks, and crypto-backed stablecoins place trust in collateral, then algorithmic stablecoins place trust in algorithms. Without needing collateral assets, they maintain their price through supply and demand regulation mechanisms, minting more when the price is high, burning supply when the price is low. A model that sounds perfect in theory, but reality is a completely different story. The Terraustus project is a prominent example, and also a classic collapse. The US stablecoin was paired with a second token, Luna, which acted as a buffer to absorb volatility. When UST lost its peg, for example, dropped to 0.98, users could exchange one UST for $1 worth of Luna. This difference was intended to incentivize users to buy UST to exchange for Luna, thereby increasing demand and pulling the UST price back to $1. Conversely, if UST rose above its peg, for example, to 1.02, users could exchange $1 worth of Luna for 1 UST, then sell it on the market for a profit. In theory, this was a perfect arbitrage mechanism for price stability, but it all relied on the belief that Luna had real value. When UST began to lose its peg in May 2022, the market panicked, and people rushed to exchange UST for Luna to exit the system. The system responded by printing Luna without limit to meet withdrawal demands, hoping to absorb enough UST out of the market and bring the price back. The result, UST demand did not recover, while the Luna supply exploded, leading to hyperinflation, and the Luna price fell to almost zero. Both tokens sank together within days, causing over $40 billion in market value to evaporate. The Terra collapse was not just a technical accident, but an expensive lesson for the entire crypto industry. A model, however rational on paper, if lacking a solid financial foundation and user trust, will collapse with just a slight slip. Since that incident, almost all similar models, such as Ample, Basis Cash, or Waves Neutrino, have gradually faded, giving way to more cautious and realistic approaches. Behind each type of stablecoin is an ideology. Do you trust the government, crypto, or algorithms? But regardless of the model, all are trying to solve the same problem, creating a stable unit of value that can move globally without relying on the traditional financial system. And as stablecoins become increasingly popular, the very question of who should have the right to issue money is becoming more ambiguous than ever. Part 2. The silent boom. They aren't as loud as Bitcoin breaking new highs, nor as exciting as the nth explosion. But while the entire crypto market has gone through cycles of frenzy and collapse, stablecoins have quietly developed in a different direction, silently, steadily, and extremely pragmatically. In 2024, the total transaction volume using stablecoins reached $30.8 trillion, surpassing even Visa, and accounting for over 50% of total on-chain activity. Nearly 200 million wallet addresses have used stablecoins. The total market supply reached $235 billion, equivalent to 1.1% of the total M-to-money supply of the United States. And the majority of that, around $142 billion, belongs to a familiar name, Tether. This is no longer a tool exclusively for DeFi enthusiasts. Stablecoins have now become true digital dollars, serving everyone from small retail traders to cross-border businesses, to people in developing countries. Stablecoins are not just a technology. They are a practical solution to a host of problems left by the traditional financial system, especially for those on the fringes of globalization. In developed countries, you can use a Visa card to pay for a cup of coffee. But in Lagos or Buenos Aires, maintaining a dollar bank account is a luxury. There, people don't invest in crypto. They simply try to hold USD, and stablecoins are the most viable option. No paperwork, no banks, just an electronic wallet. In Turkey, where inflation exceeded 70% in 2022, stablecoins became a popular way to preserve value. In Nigeria, people use USD as the primary currency for online transactions. And in Argentina, a country with strict capital controls, stablecoins open a path to escape a restricted banking system and a depreciating local currency. But stablecoins are not just for individuals. In international trade, they are being used as a new payment layer. Imagine an oil company in the Middle East selling to a customer in Asia. Instead of waiting for bank confirmations, facing exchange rate risks, intermediary fees, and cumbersome procedures, they can transact instantly, cross-border, without going through a central bank. In 2024, Tether facilitated a $45 million oil deal in exactly this way: fast, efficient, and hassle-free. In the DeFi sector, stablecoins are the lifeblood of the ecosystem. They are the unit of account, collateral, and the medium for lending, borrowing, payments, staking, liquidity provision, and even farming. The ability to participate in a financial product, earn returns, without banks or paper contracts, is the magic that DeFi and stablecoins have created together. And then there's another, less talked about area: remittances. Over $800 billion is sent annually by migrant workers to their families. With average fees of 6-8, tens of billions of dollars are lost each year to intermediaries like Western Union. Stablecoins, with instant transfer times and near zero fees, are becoming an ideal solution, not just in theory, but in reality, especially in Africa and Southeast Asia. In short, stablecoins are entering everyday life not through policy or propaganda, but through utility. If one had to choose a reason why stablecoins are noteworthy, it's not just because they do what traditional money does, but because they do it better, faster, cheaper, and are more suited to the modern pace of life. You can send a stablecoin via Ethereum in about 12 seconds, a figure that might not impress Web2 users, but is still a leap compared to international banking systems. If you transfer via Tron, the speed is only about 3 seconds. And if you use Plasma, a new blockchain designed specifically for stablecoins, the transaction completes in under 1 second, with zero fees. And the Pi Network project aims to become a common daily payment method for everyone. It will exist alongside other methods, simply giving us another choice. However, Picoin is still in a testing period to gain the trust of users worldwide. Compare that to the traditional financial system. SWIFT can take up to 5 business days to process a cross-border transaction. Visa and PayPal still rely on a percentage-based fee model, which is unfriendly to microtransactions. Even Visa, in 2023, processed 276 billion transactions, but the average value per transaction was only $54. Stablecoins are different. In 2023, the number of transactions was only 2.6 billion, a very small fraction compared to Visa, but the average value per transaction was $4,200. This shows stablecoins are currently operating on a different level, where users are no longer just individual consumers, but people handling more significant cash flows of trade, investment, capital transfer. They are not yet widely used for bowls of pho or morning coffees, but they are already shaping the standard for transactions that require speed, stability, and low cost. And like any network-based technology, the internet, telephones, or social media, the more users stablecoins have, the faster the surrounding ecosystem develops. As more people transfer money using stablecoins, more merchants begin to accept them as a form of payment. More e-wallets integrate stablecoins into their default interface. More DeFi applications, SECs, cold wallets, hot wallets, build products around them. And each of these steps, however small, contributes to strengthening trust. Stablecoins don't make anyone a billionaire overnight. They don't promise X100 returns. But what they are quietly doing is rebuilding the infrastructure of money. One line of code, one transaction, one use case at a time. Part 3. The first cracks. When stablecoins are no longer stable, every new technology must go through a period of testing. For stablecoins, the earth-shattering shock came in May 2022, when the Terra ecosystem collapsed. The consequences were not just a massive bank run, it was a crack in trust. Stablecoins, once considered safe, were no longer invulnerable. The question was raised, is any model truly safe? Who is supervising? After the Terra collapse, the stablecoin market lost its initial innocence. The feeling that everything will self-balance if designed cleverly enough suddenly became too fragile. What was once considered groundbreaking automatic elastic money supply mechanisms, market-regulating algorithms without collateral now became living proof of a painful lesson: trust cannot be programmed. So, if Pi Network is mined for free, what basis do people have to believe this currency has value? What prevents people from selling their Pi coins when they haven't put up any collateral to own them? Of course, Pi Network's value isn't formed based on mere belief either. Pi Coin is actually operated by the social chain company with its policies to ensure supply and demand in the market. They create demand for using Pi Coin and control the supply. So Pi Coin will have value based on its usability. If you sell Pi Coin cheaply, others will readily buy it to use the Pi you sold cheaply. If the demand for Pi Coin increases, of course, its value will also increase. How much it increases depends on the regulation of the team and company behind Pi Network. This is a decentralized project in terms of mining, ownership, and use of Pi Coin, but the value of Pi Coin can be completely stabilized. On the part of lawmakers, the Terra collapse was like an unignorable warning bell. In the US, draft bills like the Stablecoin Regulation Act were introduced to more tightly control how stablecoin issuers operate, requiring reserve transparency, regular audits, and in some cases, limiting circulation size. Europe quickly passed MiCA, a comprehensive regulatory framework for digital assets, including stablecoins, with clear standards for liquidity and stability. The market also self-adjusted. Trust in algorithmic stablecoins almost completely disintegrated. Names like Ample, Basis Cash, or Waves Neutrino, once considered big plays in DeFi, now faded into oblivion. No one was keen on models based purely on technical mechanisms without a real value basis. But the strange thing is stablecoins didn't die. Instead of collapsing, they adapted. And it was precisely during that chaotic period that a new generation of stablecoins began to take shape: more realistic, more flexible, and more mature. Fiat-backed stablecoins like USD and USDC no longer shied away from audits. They proactively published reserve reports, collaborating with major accounting firms to ensure each token was backed by real assets. Meanwhile, crypto-backed projects also adjusted their strategies. MakerDAO no longer aimed to build a system completely separate from traditional finance, but moved towards a hybrid model, leveraging both the liquidity of real assets and the automation of DeFi. Even new algorithmic models, if they still exist, have taken a more modest approach, focusing on risk limitation rather than promising perfection. Gone are the 50-page white papers full of macroeconomic algorithms drawn up by financially inexperienced programmers. The dream of a completely decentralized currency hasn't been abandoned, but it's viewed with more sober eyes. And like any purification phase in technology, what gets blown away by the storm are usually models lacking internal strength. The rest, the stablecoins that understand their position, risks, and roles, form the foundation for the next chapter. Part 4. The last mile of currency. Unfinished bottleneck stablecoins can move instantly on the blockchain, cross-border, without going through the banking system, with almost zero transaction fees. But when stablecoins reach the real world in layman's terms, when you want to withdraw money, buy goods, or use them like cash, all the complexities begin to emerge. The financial world calls this the last mile, the final leg where digital value needs to be converted into practical, usable value. Although the technology is ready, the user experience is still limited by infrastructural and legal bottlenecks. In many countries, withdrawing stablecoins to cash is still a multi-step journey. You need an exchange account, identity verification, and an intermediary banking partner, and none of these elements were ever designed for a seamless experience. This is why Pi Network is launching at this time, as it is the vehicle connecting the real world and cryptocurrency. It removes the difficulty of access as well as the high knowledge requirements. Soon you will be able to see pay with Pi models appearing everywhere, as well as the legality of Pi network as it has been licensed for operation by the US government, European countries, and China. 5. When the masses meet infrastructure, the true foundation for a new currency despite many bottlenecks. Stablecoins possess a weapon that very few financial instruments have ever had: the network effect. Just as WhatsApp became indispensable when friends, colleagues, and family all used it, stablecoins also grow stronger as the number of users increases. Each new user not only adds a transaction, but also increases the utility of the entire network. Merchants start accepting stablecoins. E-wallets integrate stablecoins as a matter of course. DeFi applications build products around them, and digital asset issuers begin to price in stablecoins. Tom Blomfield, co-founder of the digital bank Monzo, once said, "Every new user makes the product better for existing users." This is also known as the network effect, and it is entirely true when we talk about the stablecoin market landscape. But there's something few people talk about: the network effect only unleashes its power when the infrastructure can handle it. Imagine living in a neighborhood where all your neighbors switch to using a new type of currency, but the nearest ATM is 50 kilometers away, e-wallets constantly glitch, and every money transfer incurs high fees. The network may be growing, but if the infrastructure doesn't keep up, that growth ironically becomes a burden. And that is precisely why, after the Terra shock, those who truly understood the importance of stablecoins no longer focused on financial products, but began to rebuild the infrastructure from the ground up. You now understand why Pi Network has had such a long preparation period, right? Overcoming all these shortcomings is not simple. However, few people pay attention to this point as everyone is still focused on the price of Pi coin on exchanges. If stablecoins teach us anything, it's not that currency needs to be replaced, but that it needs to operate better. We do not deny the role of the traditional financial system. It has served the world for centuries. But the world has changed. We are living in an era where data moves instantly, people connect across borders, and the economy is no longer confined within the borders of a single nation. In this context, the way money moves also needs to be reshaped. Pi Network is silently and continuously developing to become a means of payment in daily life, as well as the connecting thread for everyone to the Web3 world. If there's anything to complain about, it's only from those with a short-term vision who cannot understand why Pi Network is taking so long.